Hello and welcome to NC Explains, an investor education initiative brought to you by Money Control and Invesco Mutual Fund. Mutual fund investing has been long synonymous with investing in equities. However, there is a lot more you can do. In fact, mutual funds have a role to play in your portfolio even before you begin investing for wealth creation. The first step in managing your personal finances is not really investing. It's about creating an emergency corpus which can bail you out of unforeseen financial emergencies. Ideally, you need to have at least 6 to 12 months worth of non-negotiable monthly expenses set aside in a stable, low-risk investment option. How can mutual fund schemes help? Well, mutual funds also offer a simple investment option with low risk and reasonable return for investors. By now, you may be well aware that mutual fund schemes invest across equity, fixed income, commodity assets, and more. If you want to focus on relatively lower risk and also add some return, you have to look for assets where the yield is reasonable and the time to achieving that yield is relatively short. This is where liquid and ultra short-term funds fit in. These types of mutual fund schemes invest in low maturity bonds and money market securities like government, treasury bills, bank certificate of deposit, commercial paper, etc. The maturity of securities in a liquid fund can go up to a maximum of 91 days. This low maturity reduces the potential interest rate risk. This means that the daily NAV of the scheme under normal circumstances has bare minimum fluctuations. The cost of investing in a liquid fund is also low, and that's beneficial for the potential net yield. Liquid funds may come with a short 7-day exit load meant to discourage quick redemptions. However, this is more relevant for large sums parked by institutional investors rather than regular investments by individual investors. Liquid funds are also very flexible, allowing you to redeem partially or in full at any time. You may also invest in lump sum or via SIP. Just like liquid funds, ultra short-term funds can also help with parking funds where you require relatively lower risk before looking at optimizing returns. These invest in fixed income securities which have a maturity profile between 3 to 6 months. These funds too usually do not have any exit load, which means you can redeem partially or in full anytime you want. They are flexible in terms of adding or redeeming funds at any time and one of the low-cost schemes within the mutual fund umbrella. Both liquid and ultra short-term funds are best suited for your short-term goals and to invest your surplus cash, which you do not want to invest in high-risk schemes. These funds are well suited to build an emergency corpus thanks to their relatively lower risk profile and flexibility. What you need to do is first estimate the amount you want to keep aside in your emergency corpus. For salaried employees with reasonable visibility of income, keeping 6 months' worth of expenses catering to your monthly needs may be good enough. For freelancers, business owners, professionals, and gig workers, you may need up to 9 to 12 months of expenses kept aside depending on how secure your income is. Once you have ascertained the value of your emergency corpus, you need to determine how much money you can keep aside to cater to this need. You may already have some lump sum saved up which can go towards it, and any deficiency can be made up with doing systematic investments in the liquid or ultra short-term fund of your choosing. What you need to focus on while choosing these schemes is a portfolio that has securities of the highest credit rating. These funds are intended to be used by you as a means to preserve capital, which means the portfolio should be top quality in terms of the credit rating. Secondly, look for schemes from experienced asset managers and fund managers And lastly, schemes with a low minimum investment requirement, so that if you don't have a lump sum to invest, you can start a steady SIP. Once the amount is defined, work backwards to ascertain how much you need to invest every month to achieve this corpus. It may take a few months or even a year plus to achieve this. When you get there will depend on the surplus you have every month. If at any point in the process you receive lump sums, say from bonuses or gift money, you can simply add that all into the same liquid or ultra short-term scheme and continue building your emergency corpus. Ensuring that your financial emergencies are covered such that you don't have to dip into your long-term savings in case of an eventuality is a precursor to building your long-term investment portfolio. So what are you waiting for? Just get started now. Hope this episode was useful in piecing together your financial life. Stay tuned for more such information on MC Explains.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.